Hello everyone, welcome to NRI Legal World. Today, we are addressing queries that we have been receiving quite frequently from NRIs who are planning to sell their agricultural land in India.
Many of them are concerned about one key issue: if they sell their agricultural land, how much tax will be deducted from sale proceed which they receive from their buyer.
This concern mainly revolves around capital gain taxes, which often feels confusing and overwhelming. So in today's video, we will break it down for you in a simple and clear manner and help you understand what exactly you should expect when it comes to taxation in such transactions. So let's get started. So the first question that we have received is that as an NRI, do we have to pay tax on the money which we have received after selling our agricultural land, which is partly ancestral and some part of it was bought before shifting to Canada?
Yes, if your agricultural land is an urban agricultural land, then you have to pay tax on the money which you have received after selling your urban agricultural land. If you have sold rural agricultural land, then there is no need to pay any tax.
Many NRIs have this confusion that how do we know whether our land is rural agricultural land or urban agricultural land?
First of all, it is important to understand that what is meant by agricultural land under Income Tax Act 1961. Agricultural land is classified into two types, that is rural agricultural land, which is not treated as capital asset, so there is no tax on it. Second, urban agricultural land, which is treated as capital asset, so there is an applicability of capital gain tax. Then how to determine whether land is urban or rural? The classification depends on two factors. Number one, population of the municipality. The land must be located on the municipality of cantonment board having a population of 10,000 or more as per the last population census. If the population is less than 10,000, the land will be considered as rural agricultural land regardless of distance. Second is distance from municipality. Distance must be measured straight line aerial distance, not by road.
So what are the correct limits?
The correct limits are up to 2 kilometers if the population is between 10,000 to 1 lakh, or up to 6 kilometers if the population is between 1 lakh to 10 lakh, and up to 8 kilometers if the population is more than 10 lakh. The land is treated as rural agricultural land if it is outside the specified distance limits or population of the municipality is less than 10,000. To determine whether agricultural land is rural or urban, always check the population of nearby municipality and aerial distance from it. If the land falls within the prescribed distance limits, then it is urban agricultural land and it is taxable. If land falls outside those limits, then it is rural agricultural land and there is no tax on it.
So the next question asked by the NRIs is that do we need to give some proof about this calculation of distance? And how do we get that proof?
Yes, proof is important, especially in case of scrutiny. You can prove it using revenue records like Jamabandi, certificate from Tehsildar, who does it with Google Map with aerial distance method. Distance is calculated as aerial straight line distance, not road distance.
The question which we get asked the most by NRIs is that how much capital gain tax are they going to charge from us in India if we sell our land, which is urban agricultural land?
If it is long-term capital asset, the tax rate is 12.5%. Otherwise, tax rate is totally depends on income tax slabs. If it is long-term capital asset, the tax rate is 12.5%. Otherwise, the tax rate totally depends on income tax slab.
This is quite a big amount which is going to be deducted from the sale of urban agricultural land. Is there any way to save this amount from being deducted as capital gain tax?
Yes, you can save capital gain tax by some methods. Out of the capital gain money, you can buy 2 houses anywhere in India. You can buy a plot on which you have to construct a house within 3 years. You can buy bonds up to 50 lakhs, but profit earned from these bonds will be taxable. But NRIs must remember they cannot buy farmhouse, plantation land, agricultural land from this money because that is totally prohibited.
And with that, we have addressed some of the most common questions that NRIs have regarding the sale of agricultural land and the tax implications involved. We hope that this video has helped in bringing clarity to your concerns and given you a better understanding about capital gain taxes.
If you still have any question, feel free to drop them in comments. We would be happy to help you. If you like this video, don't forget to like, share and subscribe NRI Legal World.
For any professional guidance, you can contact NRI Legal World. Thank you.